Welcome to the Snowbirds Expat Radio podcast, powered by the Snowbird US Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, welcome to the Snowbirds Expat Radio podcast. I have a returning guest. And we'll announce some, we'll talk about an announcement after the podcast or towards the end of the podcast on how we're going to make this young kid from Victoria a co-host. And we're going to drive you crazy and educate you about renouncing going forward. So we'll go into a little bit deeper than that. But Robert, welcome to the podcast. I know we had a chance to have lunch the other day. We made that long drive over to Victoria. A bit of a drive, a little bit of a swim, and then we were able to meet yourself and your lovely wife. And I think we solved all the problems, all the world's problems. But welcome back.
We sold 99% of them.
I think so. I think so. And I think the reason why we did it is because it was solved within British Columbia, and we didn't have any interference from Mike from Toronto with his views on how things should be solved. So anyhow, so today we're going to be talking about something very, very interesting. And a lot of people might not know this, and I don't even know why we're talking about it. But Robert, you're going to have to tell me. So we're going to be talking about, it's called net investment. It is called NIIT is the abbreviation. But tell me what that is and why are we talking about it today?
Well, it stands for net investment income tax. And it's an extra tax that a lot of folks, American citizens that file here in Canada and abroad, are subject to. And, you know, it's interesting in the fact that with, in particular, increased property valuations and subsequent sales thereof, we're seeing a lot more of this income tax being applied and subjecting American citizens that live abroad too. We have lots of clients and it's the same grievance. I'm living in Canada. I pay Canada a lot of tax. And in a sense, well, not in a sense, in reality, because I'm paying the NIIT, I'm being double taxed. What can I do about it, right? And more importantly, what is it? Which a lot of folks just simply don't know. So if you want, I can give you a little bit of background about where it comes from, where it came from, future of it, you know, where we see it going, especially with this recent court case, a couple of court cases actually. So
now I'm going to guess it might be coming from one of the Democratic presidents. No,
Indeed, you bet.
Okay, so tell us where it came from and why.
Well, you recall in 2009, January, when President Obama took the helm, one of his campaign promises was to usher in some form, American style, of universal health care. So they came up with, what's commonly called Obamacare, right? It's a health care network, which, in theory, pools millions of users, provides subsidies for less advantaged, poor taxpayers. And those subsidies are paid for in part by the NIIT, as well as a penalty provision. Folks that continued not having health insurance, as a means to fund those that need or require healthcare or desire healthcare. So they brought in the Affordable Care Act in 2009, included those two provisions, the penalty provision as well as the NIIT. In 2017, President Trump took over. Congress repealed the penalty portion, but unfortunately left the NIIT in place, right? And so that's where we're at. Penalties gone. The NIIT, that 3.8% surcharge, remains. And that's really where, a lot of folks that are subject to it, they're indeed double taxed, right? And I can explain that a little bit later.
Yeah, so I guess the thing is that and when does that NIT the NITT tax NIT tax, when does it apply? So here's an example. I'm a dual citizen, um, Canadian and US, and I just sold a piece of property in Canada. Does the NIIT tax come into play? Does it affect me?
Well, real property sales, those are passive in nature. So very first thing we have to do is distinguish between active income, wages, self-employment, unemployment insurance. Those are considered active. Passive, capital gain, uh, dividends, interest, those are passive. So we have to determine what's passive, what's not. We also have a look at what's called the modified adjusted gross income. And that's really our starting point. That includes both the passive and the income or active income, wages, unemployment. Add those together. And the way you calculate the NIT, you have to determine, okay, what's my filing status? Am I single? Am I married filing separate, or am I married filing joint? Give you an example. I file married filing separate. My wife is Canadian, not a US person. And so for NIIT purposes, my first $125,000 of modified adjusted gross income, or MAGI, as they call it, is exempt from the NIIT. Amounts of passive that exceed that 125,000 are subject to a 3.8% surtax. So, for example, if I had 135,000, first 110,000 of the addition was passive income, then that $10,000 is going to be subject to that 3.8, and I'm going to owe NIIT, right? Because of that. And so you can see your example. If you sell a house anywhere in Canada, you're looking at potential millions, especially here in Victoria, Vancouver areas, right? Millions of dollars of potential exposure that's going to be subject to that 3.8%. So it can add up quick, right? And it's a tough pill to swallow. You pay Canada upwards, the top rates here, like 53%. And on top of it, you're going to have to pay an additional 3.8 to the United States. And it's the country, yes, you're a citizen of, but you don't live there. You don't work there, and you don't reside there, right? Definitely.
It's very interesting. I'm going to come up with a game show, and I'm going to get all these accountants together, and they're going to be having to know for 100 points what is NIIT or what is MAGI.
Yes.
And your industry has so many acronyms. So here's a question for you, and I hope I don't lose this thought here. With that additional tax that I'm paying, the 3.8%, is there a foreign tax credit that can offset some of this tax, so I won't have to be double taxed in the United States?
Well, under current regulation and rules under the Internal Revenue Code, there is no provision to apply foreign tax to the NIIT, right? Flat out. And that's the position the IRS currently holds. Now, with that being said, there have been one very recent case in the Court of Claims, which pertained to Canada. The previous one pertained to, I believe, the France-US income tax treaty. In this, the Court of Settlement, I believe it's the Court of Federal Settlements. Correct me if I'm wrong, but they basically said, well, wait a minute, because the income tax treaties, France, Canada, etc., are really designed to prevent U.S. citizens that live abroad from being double taxed. The court, now keep in mind, it's a very low court. It's the lowest court. So both decisions are currently before the U.S. Appeals Court. But that court, the lower level court, said you can carve, or the tax treaty, I should say, U.S.-Canada tax treaty provides, irrespective of what the IRC says, Internal Revenue Code, means to apply a foreign tax credit as an offset against that 3.8%. That's huge, right? That's a huge win for the taxpayer. Now it's going to be interesting to see what the appeals court has to say, quite possibly the Supreme Court. Now, typically when there are tax matters at play, and you've got either the tax court or this court, for example, appeals courts, including the Supreme Court, they'll provide a lot of deference to that decision, right? And they'll depend on it. So you never know. Taxpayer may prevail, and if the taxpayer prevails, then NIIT goes away, because we would absolutely be able to apply foreign tax credits in the event that Canadian tax is paid on that same source of income. Gets a little muddy where you're selling a principal residence, right? It's exempt from Canadian tax, so you would just come up short anyways on foreign tax credits, but you wouldn't be subject to that additional 3.8%. There's also things we can do to help mitigate those capital gain, the capital gain exposures from principal residence, but we can deal with that on a different podcast if needed.
Well, it's interesting because, a lot of times, you hear about these acronyms and you're aware that it is helping to have, the affordability of Obamacare in the States. And then when I was driving home, or when we took the ferry home, I get some notification from a lawyer out of Vancouver here, and his name is slipping my mind, but there's a 38-page adjustment. I think I sent it to you right away.
Yeah, the court decision.
Yep. Yeah, it's very interesting.
And the court, in that case, the court did exactly what the court did in the other case, which concerned the U.S.-France tax treaty. They said that by virtue of the treaty does indeed provide foreign tax credit relief with respect to the NIIT. That's what the court said, straight out. Of course, the IRS disagrees, and they say, look, foreign tax credits only apply to income tax. The Obamacare tax technically isn't an income tax. It's a Social Security tax. But isn't it strange how it's called the net investment income tax, even though the IRS considers it a different type of tax? But both courts in these lowest level decisions ruled in favor of the petitioner, taxpayer, and said no, under the treaty provisions, that provides basis for this NIIT foreign tax credit. Apply it, you owe nothing, you're good to go. Of course, the the IRS appealed it. And so we're going to have to wait until the appeals court makes a final ruling on it. So a person who's pulling out their RMDs, required minimum distributions from an IRA, there is no tax on that. No. Roth, pulling funds out of the Roth. That's NIIT. I'll just call it NIIT. That doesn't apply. This doesn't apply. Yep. Now, what about, and it doesn't apply to principal residence if you have income of over $200,000 or $250,000. Yep. Does it apply to your principal residence in the United States? If I was just an American and I sold off my house? It does. Again, if you're single, you have a $250,000 exclusion. Okay. If you're married, that's $500,000. Any amounts above, you're going to be subject to capital gain, which is generally a rate 15%. It can go as high as 20%. Again, depending on your Maggie amount. Yeah. So the Democrats brought it in. The Republicans are not going to get rid of it. Well, the Republicans in 2017 had a chance. They could have repealed it, but they chose not to. I suspect it's because it brings in a lot of money, right? And you know what the U.S. budget deficit is. It's nearing critical mass here. So I think going forward, yes, President Trump, well, I should say President-elect Trump, has vowed to repeal Obamacare, et cetera, et cetera. So if Obamacare is repealed and we go back to the way it was, say, in 2009, prior to the enactment, then I can only assume they will repeal the NIIT provisions as well, right?
We're facing the same thing in Canada right now, as you're aware, with the Liberal government coming out and saying you've got $250,000 exemption on your capital gains, which will be taxed at 50/50, and anything above that is going to be taxed at 66 and 2/3. So regardless if the Liberals bring it in, and it hasn't been voted in, I get it, but we're not hearing anything about the Conservatives saying, elect me and we won't do that to you.
See, the way I figure, the party in power going forward, I know they want to try to balance the budgets, but there's only a few options, right? You can make draconian cuts to Social Security in Canada, means tested even more, right? You can cut, or you can increase taxes. Well, Canada is one of the highest tax jurisdictions, right? Or you can dramatically increase immigration, and they're already cutting immigration. So it only really leaves two options: draconian cuts or increased taxes. So, will they bring that capital gain threshold back down to 50%? I don't know. Politically, it would probably be a good move for them, right? I think the public would overwhelmingly agree and support it. Fiscally, I don't know if it's such a good idea because the baby boomers are now all coming online. There's even more demand for social services, OAS, CPP, the medical sector, etc. So these government, the governments, federal government, provincial governments, they're going to need all the money that they can scrape together moving forward. So,
you got to remind me, what does a balanced budget mean? I haven't heard that. I haven't seen it. I'm 63 years of age.
I saw one when I was living in Seattle in 1993.
Okay.
That was the last one. Yeah.
So there's a better chance of seeing the Okopoco or Bigfoot long before you'd ever come across a balanced budget.
There's a better chance of seeing the Cleveland Browns make the Super Bowl.
Oh, so you're saying there's a chance?
There's a chance. We could do the whole Dumb and Dumber, 1 in a million.
Yeah, 1 in a million. It sounds like I got a chance. Well, it's very interesting because, like I say, this is becoming more and more popular, and you're seeing it for people that can afford your services. You're seeing those people that have to be concerned about the net. We're seeing it on the wealth management side. We're seeing it because of the families we're fortunate enough to work with. But it's another problem out there. So I appreciate.
It is. And one caveat: it really does impact higher wage earners generally. But again, I don't know if they anticipated this, but again, as I mentioned earlier, property valuations here in Western Canada, British Columbia in particular, are sky high. So when they sell rentals, when they sell principal residence, oftentimes they're subjected to this NIIT, and the bill, right, the liability can be in the thousands. We're talking $40,000, $50,000, $60,000 range, right? So it's tough to digest as an American citizen living in Canada. And keep in mind, this is Canadian source income for which now the IRS says, oh, wait, you don't have a tax credit. Sorry, wrong kind of tax. And that's where the lower court stepped in and said, well, wait a minute. We have these tax treaties. We can create a foreign tax credit based on the treaty, which was ratified to do one thing, and that's to eliminate double taxation. Right? Not all instances, but that was generally the theory behind these treaties, right?
And once again, that $200,000 is $200,000 for a single is based on USD.
250,000, yeah.
USD,
yeah.
So obviously that would be filed on the U.S. tax return.
Yeah.
You would see the net on the U.S. tax return.
That's correct. Yep.
And that's where maybe those foreign tax credits could be a little hard to manage.
Well, foreign tax credits, keep in mind, we can roll those forward 20 years, right? So after many years of filing, generally taxpayers, because again, the rates here in Canada are much greater than just the US federal rate. They have a large bank of available foreign tax credits in addition to the current year credits that we would calculate as well. So that's one saving grace, right? But again, what we're seeing is the application of this NIIT with respect to sales of principal residence, sales of rental units, et cetera, right? The other thing that kind of is, problematic with respect to rentals is, under Canadian rules, landlords don't have to take depreciation. It's discretionary. And, almost all Canadian taxpayers don't depreciate the rental properties, whereby under US rules, depreciation is mandated. You have to take it. And when you sell, it comes back as recaptured income, subject to a 25% rate of tax for US purposes. So, that's another thing. You got these values that have appreciated steeply just in the last few years, which is, again, triggering more recapture. It's triggering simply more capital gain and then more NIIT. So,
okay.
I mean, it's kind of a double-edged sword because we're all enjoying these great valuations, in particular when you sell, right? But then we have to live somewhere. Unless you're going to plan on living in, northern Saskatchewan, on a remote cottage on a lake, which you could probably get for under 500,000, you're going to be paying, unfortunately.
So let me ask you this. If you're using a 1031 rollover, are you able to defer that NIIT?
Not for Canada. It just fails. It's considered a sale.
Well, it doesn't work on the Canadian side. But what about the U.S. side if you're trying to do a 1031?
It would defer it all. Yeah, it would defer it. Yep.
It would. Okay.
Yep.
Well, this is a great segue into one of our announcements, which is we're going to be seeing more and more of Robert on our podcast because he is going to be one of our co-hosts when we talk about things like renouncing. And renouncing, go into the details of what renouncing is and how popular is it out there these days?
Well, renouncing is, the United States is unique. It really is one of the only countries, I believe there's another one, Eritrea,
in Africa.
In Eastern Africa,
yeah,
right? That taxes on a worldwide basis on citizenship, right? Mm-hmm. And it stems back to the U.S. Civil War, right? They needed to fund it, at least the North did, the Union. Mm-hmm. And so, thousands, if not millions of Americans were fleeing both the North and the South. They were going to Canada. They were going to Mexico. They were going back to Europe, right? So Congress said, well, wait a minute. You can run, you can't hide. We're taxing American citizens regardless. And so moving forward, 200 years or 150 years, that's still the case. So really the only way you can escape from worldwide taxation is if you renounce your U.S. citizenship, right? Then it takes you completely out of the system, the U.S. system of taxation, provided you follow certain procedures, right? Namely, and keep in mind, renunciation is really two streams of law. We have the Immigration Act, which is one side, and we have the Internal Revenue Code, which is the other. So the formal act of renouncing is it takes place before a U.S. consulate. It has to be done abroad, right? U.S. consulate or embassy outside of the United States. And then the second is the IRS, right? So before, you can renounce, but in order to terminate any future filing requirements of the IRS, you have to have 5 complete filings, IRS filings, in the 5 years immediately preceding your renunciation. In the 6th year, the year you renounce, you file a final 1040 NR, dual status, puts the IRS on notice that you're no longer a U.S. person, along with that Form 8854, which is the expatriation, initial and annual expatriation form. The process has to be followed strictly. You don't want to deviate from it. As long as you do that, then future years, you're not subject to income tax filings, any information forms like FBARs. You would be subject to filing requirements in the event, say you're renounced, but you still have a rental, say in Arizona. You would be like any other Canadian-only citizen. You would then file a 1040-NR, pick up that U.S. source rental income, pay whatever tax, and then you report that on your T1 Canadian income tax return. So, but you would not be required to file FBARs, 8938s, the whole 9 yards as U.S. citizens that live abroad currently do.
When we talk about renouncing, and we'll do this more, we'll probably do a show every 6 weeks or every 4 weeks on renouncing because it's so popular. But there's so many things to be covered under renouncing. And I think there are people out there that believe that everybody should renounce. We know that. We've had discussions about this where, some of those people that believe that are very, very high pressure for some people. Yeah. But I'm sure there's going to be some people you sit down with and you're going to be able to say, no, I don't think renouncing makes sense.
100%. It really depends on the person, right? Age. How old are they? What do they do? Do they have any business activity in the United States whereby you take that citizenship away? It becomes harder to transact business, right? Medical services. That's another one. Although, renouncing doesn't affect your Medicare, it doesn't affect your Social Security or anything like that. You're now not a U.S. person, so you don't have that automatic right of reentry. You're like every other non-U.S. person. And so you never know what's going to happen at the border, right? Maybe someone's having a bad day. One of the border guards, and, he gets wind. He sees your Canadian passport and it says Seattle, USA. Next question is, where's your U.S. passport? And then the reply is, oh, I renounce my citizenship. Now, I've never heard of an instance where anybody really cares at the border. Never. They just let you in, no problem. But you never know, right? Congress could pass a bill tomorrow, which requires all former U.S. citizens to first secure a visa before they enter the United States. Now, current visa processing times in the Vancouver consulate, about 2 years, right? And if that was made a requirement, you bet it's probably going to be 4 with very low priority to process them, right? Because really the top priority for those guys, it's family-based, green card applications, business immigration cases. Those are the top priority, not so much tourist or travel visas. Right?
Well, we've always said the idea of this podcast is make sure that we're connecting. This is not do it yourself podcast. We don't have Robert here, so he can give away all the trade secrets, and you can go home and renounce on your own. We want to make sure that, and there's so many shows we can run. What happens if you renounce and now you want your citizenship back, or you've renounced, and what about your Social Security card, your Medicare, your taxes?
Well, there's a process you need to go through, not just the procedures, the consular process, the IRS. There's also more practical, right? Do you notify Social Security that you're now no longer a U.S. person, right? The answer is yes. How about your pensions, your IRA, your 401ks, right? The minute you cease being a U.S. person, then all of a sudden you're subject to non-U.S. withholding requirements, right? Which brings in a whole nother episode for Snowbirds, right?
Now,
that we can talk about. So,
Robert, you think if we made the process for renouncing, it made it easier for you to connect all our listeners that are concerning about renouncing, making this process easier and better explained? Excuse me. Do you expect that you could see an uptick in renouncing? People don't renounce because maybe they're threatened or uneducated.
A in my practice, I focus on educating, right? The folks, the paperwork, and incidentally, the procedures the consulate now require are more onerous. They have a new 18-page application you got to be really careful about. So, buyer beware if you're trying to do it yourself, because the process has now, like many processes, right, it's become more complex, right? So you want to make sure you get it done correctly the first time. But, I take an approach where I counsel. We want to make sure that before the client steps through the door, gets past the security, that they know exactly what's going to transpire before them. Everything from, hey, how do I make that filing fee application? Is it cash, credit card, debit? What are they going to ask me? What don't I want to say, right? When it comes to renouncing, what do I bring with me? Everything from name change to passports, whole 9 yards, right? So I like to have, my practice, I like to just ensure that, one, the client gets their money's worth. That's number one. And what I mean by money's worth is they are going to be ready for that appointment, and they are not going to feel overly, because everyone feels something, it doesn't matter if you're well prepared, you'll be a little anxious, but your anxiety won't trip you up, and you'll really fully understand what's, the proceedings before you and how best to answer any questions that might be asked of you. That's it.
Well, I'm excited. And like I say, I think the first podcast we're going to do is probably about 3 or 4 weeks out. We've got Christmas to manage and all these other things. So we are excited. But
Robert, let me know if I need to do it from Arizona. So I'll be there for a few weeks.
Oh, you're going to be there in Arizona? Well, we're going to have to, we're going to see if we can connect from Arizona to Maui. See if there's some kind of idea or strings and toucans or however we do it. But we are excited because, the idea is we want people to feel comfortable. They can call us up. We get a lot of calls and we just direct them to our partners that we work with. And in this situation, there is that change in the format where you'll see less guests and more co-host because we want people to really be comfortable, go to the right place and get this done. If you're threatened by renouncing or have anxiety about it, Robert's going to be the person to take you through it. So, Robert, I enjoyed our lunch. I look forward to, sounds like I kind of talked your wife into coming to Maui and
Absolutely.
kind of got you a little bit of trouble. No more boy trips to to Maui on your own. So you're going to have to bring your wife. And, but thank you very much for your time. Very much appreciated. And we look forward to our series of podcasts on renouncing.
Well, thank you very much. I appreciate you and your team there at Snowbirds.
Thank you again for listening to the Snowbird Expat Radio podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.